I'm Barry Russell. Welcome to the Real Estate Collaborative of January 28th, 2021. This is our first collaborative event of the year, and I'm really pleased that you're joining us for the great information that's going to be shared by our panelists. I'd like to first introduce our sponsors because their support for the collaborative over its 8-year history has been really great for us to be able to go forward and do what we do. First, I'd like to introduce our premier sponsors. Premier sponsors are Russ Keller with the Credit Law Center. He is part of a Kansas City firm that includes lawyers, and they do a great job on credit repair and restoration. Our next premier sponsor is Chris Giannino of Simple Moves. They are a company that's homegrown here in St. Louis and have a great opportunity to not only do very small moves, which is how they started, but they now can move you from state to state, and they're a full service mover and storage. So thank you to Chris for his longtime support. Next, we have Linda Borghi of Dazzle Home Staging. She does unoccupied staging services, and she's been serving St. Louis for over a decade and won many awards. She's got a warehouse full of wonderful furniture and accessories and helps hundreds of realtors all over St. Louis. She's also just a joy to work with. Then we have our certified public accountant, John Brandvine, Brandvine & Company. John is a longtime certified public accountant. He works on tax strategies for real estate professionals, IRS negotiations and resolutions, and structuring real estate transactions and entities. And we've used John in our short sale work when we've had a problem with the IRS with a client. So I can verify that he is really good. We now have Mimi Brandt, who is the new business development person for Chesterfield Title Agency in Chesterfield. They have title insurance and closing services. It's a woman-owned title company, and they have offices here in St. Louis as well as in Kansas City, including the Kansas market. They do a lot of our work, and they are really a very professional company and very responsive to realtors and their clients. Then we have Andrea Lenson of Design to Sell. They do the occupied staging, so clients that are in the home still and have furniture and accessories. Andrea takes on the often challenging task of telling homeowners how to delitter their houses and properly set up what they should have. And she will take that message to the homeowner more easily than often the realtor will. Andrea has been one of our longtime sponsors since the beginning, and she's also a wonderful source of influence for networking. Next, we have a new premier sponsor, Denise Reed and her associates and partners at the Strategic Financial Group. They educate their clients about financial concepts and products and take the mystery out of investing, insurance, estate conservation, and preserving wealth. They have helped a lot of people, not only people that are in different professions, but also a lot of real estate people. Can help you create an approach that is designed to address your unique situation. And we're really pleased to have Denise and her partners as part of the Real Estate Collaborative sponsorship. Legal Shield and ID Shield, represented by Deborah Russell. They have very affordable and excellent identity theft and legal plans. There is a group plan for people who attend and are members of the Real Estate Collaborative that gets you a considerable discount. So you may want, if you're interested, you may want to give Deborah a call to discuss that. And last, myself and Rod Hamilton, my associate, are in the short sale business, and we do short sale negotiation. We work with realtors all over Metro St. Louis, solving problems. We've had just a wide range of challenging situations to resolve. And combined, we have over 75 years of experience in real estate and mortgage finance. So our motto is we help people sleep again. Our event sponsors. We have Brian McCrae of the McCrae Mortgage team at Central Bank. Brian has also been an original sponsor, and they're a very professional company and do a great job. Dennis Cooper is in the reverse mortgage business with the Federal Savings Bank. He is also a longtime provider of that service, one of the best in the field, and can provide service nationwide. We have Dan Luig, who is an independent insurance broker with the Insurance Store. And Dan is our co-host, moderator, not our co-host and like operating partner today, helping with the call. And he's also going to be on our second panel. We have Jim Colombo of St. Louis Paint Specialist. Jim is one of the painters that's most in demand for the clients of realtors around St. Louis, and you want to make sure that you introduce him to your clients when there is a need. We have Old Republic Home Protection, which is a national company, and it's represented in St. Louis by Marcia Russo, who provides through realtors home warranty plans. Marcia does a first-class job and is great to work with. We have Integrity Title, Knox Malis, widely known in the real estate field. They do construction, dispersing, and exchange deals, and also do general title insurance. So they have 17 offices, well covered. We have a longtime sponsor in Rick Brown of Reverse Mortgage Funding. He does reverse mortgages and is well-versed in this field, does videos now and you may see them on Facebook. He is very good in working with clients of all backgrounds. We have Denise Reed again in her other business, which is Paget Business Services. They provide accounting and tax services to small businesses, and I know people that are using them and speak highly of them. Nathan Kerpen of Benchmark Mortgage. He provides mortgage services throughout Metro St. Louis, and he is licensed in many states. And we are just over to see him and his team, and they've got a great operation and very customer friendly. Three additional sponsors we have are Jim Manning and Ryan Wessels of 3 Doors. They are as is property buyers and are providing a lot of education to new people in real estate. We have the St. Louis Real Producers Magazine with Nick Najar and Diane Collins. If you haven't seen this wonderful full magazine, you need to do so. It's sent out to the top realtors in St. Louis. And lastly, we have Nothing Bundt Cakes, Jeanette Neely, who provides closing gifts and other presents for people in the bundt cakes that if you haven't had those, maybe you should start or maybe not, because I know that they are so good that you'll want to keep eating them. That's my problem. Okay, well, I believe that's our full list of sponsors, and now I have the pleasure of introducing our first panel, which is going to be anchored by 3 outstanding realtors. Each of them really are in their own business and have done a remarkable job. The first person I want to introduce is Vennessa Mastroianni, who is originally from Australia, another Commonwealth country like Canada, where I started. And she has been in the United States for 10 years. She owns and is the broker for Realty Masters of St. Louis. She's also president of the Council of Independent Real Estate Brokers this year and a board member, past board member of Maris, and a current board director of the Missouri Realtor Association. Very well qualified to be with us today as a panelist. We have the other Barry on the show, Barry Upchurch, and he is also in his own business, Barry Upchurch Realty, for 22 years in Chesterfield. He has got a long list of things he's involved in, from being past president of the Council of Independent Real Estate Brokers to president of the St. Louis Real Estate Board to Realtor of the Year in 2015, well qualified to talk about real estate matters in St. Louis, and he's also an attorney to boot. And then last but not least, Brian Preston, who is a partner in the real estate franchise PalmerHouse Realty, the St. Louis franchise. He is the managing broker, but he's still heavily involved in doing deals. In 2019, out of 2,200 agents in the PalmerHouse organization in the country. He ranked, I believe it was number 10 in volume and number 4 in units, and tells me that his 2020 results are even better. He is also a marathoner on behalf of St. Jude's Hospital, raising money for them. So we have an excellent panel, and panelists. If I've left anything out that's pertinent to you, please speak up now. I'd be glad to have you add whatever you'd like to. Okay, so let's talk about our first panel here. And the overall title is, how could the local real estate market be different in 2021? All of our panelists are going to bring, I suspect, slightly different viewpoint. We're all dealing with what we had a panel a year ago that said dealing with the uncertainty of the COVID-19 real estate market. And in that panel, which Barry Upchurch was on, we commented that the world was going through a black swan event, an unpredictable major crisis that's affected everybody's life. And actually, the real estate market surprised many of us. Certainly, it surprised me in the sense that it not only kept going, but it kept going with considerable momentum still on the upside. And today, we have, I'm told, in 43 zip codes in Metro St. Louis, we have less than 1%. In some case, it's 3/4. I'm sorry, no, erase that 1%. We have less than 3/4 of a month's inventory of available homes to purchase. So what's going on? Is this going to ease, do you think, in 2021? Brian, Preston, what do you think?
The short answer is no, in my opinion. Rates are still low. Inventory is even lower this year than it was last year. I feel like 2020 was slated to be a very busy year before the pandemic, and when it hit, for most agents, it still was a very busy year. We did take a pause in the second quarter to kind of see when everything was shut down because of COVID, and even during that time, there were still a lot of sales happening. But when things opened up in the third quarter, it was like the second quarter. So then fourth quarter was like the third quarter in regards to real estate activity. So as far as 2021, I feel like, and I know the agents in our brokerage feel like the 2021 spring market is already here. It is the second week of January. It is so busy. Inventory is so low. We're even seeing, what we've been seeing is even more offers in multiple offer situations. It's just, I don't see how it can, it's not, if the middle of the year to the end of the year slows down a little bit, that's what I could see happening. But for the next 6 months, I don't see this easing up, because I believe rates will stay where they're at. And we have an inventory problem. That's all there is to it. And I don't see what's going to change that. There were people that were buyers and sellers. There were a lot of buyers and sellers that going into 2020, they had plans to purchase or sell a home. Because of COVID, they didn't. So I believe that's why we're so busy right now, is those buyers that were ready to go in 2020 are now, they're still here without a home. And so there's all this pent up demand. And so that's why I believe we're having such a busy month in January, and that will continue into the first half of the year.
What do you think, Vennessa?
Yes, I agree completely. What concerns me, though, is the stats. 63% of Americans are living paycheck to paycheck. And since COVID, 53% of them were not, prior to COVID, I mean. We've got 5.2% of mortgages are in forbearance. That equals 2.7 million homes, and that equals 547 billion in unpaid principal. And that's just from the stat from mid-January. So I have a lot of concern about those, the people who are really suffering with the job losses due to COVID and the impact that's going to have going forward. But having said that, Lawrence Yun believes with foreclosures, the market will be able to absorb them. So, you know, it's like a tale of two cities. If you have a good paying job and you're a move up buyer or you're a first time home buyer, it's going to be insane for that market. But my concern is the bottom third and what's going to happen to them.
You kind of took the words out of my mouth when I was going to mention the bottom third, because that's where in the last 12 months, I think that's where most of the foreclosures have been occurring. And the average price on those foreclosures or short sales astonished me. It was $55,000. So it's telling me that it's the lower third, that the market may be different than the upper two thirds. Barry, how do you see 2021 unfolding?
Well, Vennessa took the words out of my mouth when she said tale of two cities. And I guess I'll look at the other tale, the 1/3 that you guys are talking about. And this is going to have a major impact upon landlords and property managers. There's a program that actually just got passed by St. Louis County. It's called the ERAP, Missouri Emergency Rental Arrears Program. And it just got passed by St. Louis County before they broke into pandemonium. St. Charles has it. It allows a landlord to collect $1,380 per month for a 3-bedroom or $1,565 for a 4-bedroom up to 6 months. But you have to agree to have your tenant stay in the house for another 120 days so they don't go out and infect other people with coronavirus. Now, what does this mean? A lot of these landlords and property managers, they owe the bank for a lot of these properties. And guess what? Do you think banks like to be risky? They're very risk adverse. And so while that income might sound like that'll get you over the hump, and the moratorium, as we know, goes on to September 30th of this year. Right now, it might get extended again, but banks are probably going to put a goose egg if your tenants are not paying on your P&L. So when you go to refinance, even though you've got low rates, they might say no. And banks have done this before and other times. So when that happens, what do you think the landlords are going to do? They can't get the tenant out. They might try to incent them to get them out, but either the bank's going to take the house or they're going to do whatever they can come October 1st to get them out of the house so they can sell the house and get out of the musical chair issue that they have right now. So that's kind of my concern, and that underlies a lot of the market. About 1/3 of the people in the world rent, and that's a huge basis for the real estate market.
Interesting point of view. At one point I thought interest rates could be a problem for us all, but then I read something recently that said that even though the era of extremely low rates could be coming to a close, the transmission might be slow. I mean, this particular writer said that the fixed mortgage rate for 2021 is likely to be around 2.9 and 3.2 in 2022. That's not a major problem for the market, but real estate's a slow. Well, historically, it's the trends have been move slowly. You're not talking about in the past, anyways, an overnight sort of crash. You're talking about a change in a cycle, and we could be still, despite all the optimism for 2021, in a cycle that's starting down. And Barry, the comments you made could, in a sense, weaken the market depending on how far that begins to eke up into the upper 2/3. And then now we have a new government, a new administration in Washington, D.C. Do you think any of the things they're doing in the area of changes, executive orders, and so on, could affect real estate? What do you think, Brian?
Biden has proposed a $15,000 tax credit for first-time home buyers. So I think they're trying to be ahead of that, and and they understand that the lower third is the one that's going to be affected the most. So I feel like they're staying on top of it, and they're already trying to propose to have things in place for when that does happen. So that was a little bit of a surprise to me that they're already thinking that far ahead. So it seems like they're in tune with what's going to happen in the real estate market. We're still going to have some problems. There's no doubt about that. And I do think, as far as the forbearances, I think there will be an extension. Would you guys agree?
I think I agree.
For sure that's going to happen.
Everybody agrees to that. Well, as far as though the demand is directly related to consumer confidence as well as good employment. And gratefully, St. Louis is about a 4.7% unemployment rate compared with a much higher national rate. Are there any things like, changing the energy policy? Are any of these things going to have an effect this year, do you think, to weaken the market? What do you think, Vennessa?
No, I don't. Not here in our region. Other regions, like in Wyoming and places like that, then yes, I think they're going to be affected. But here in St. Louis, I think we're kind of safe from major impacts of those policies.
A major diversified economy. What do you think, Barry Upchurch?
Well, I'm very concerned about healthcare, and COVID. You think, hey, this is great. Everybody's getting vaccinated, and we're saving all these people's lives. But basically, that's been supported by the government, not by the private industry. And Biden, basically, he's now the sheriff in town. He's only got 1 year before the elections for the next congressional district, though. And I think if he can, he will ramrod in Obamacare 2, whatever that means, and try to nationalize healthcare as best as possible. Now, the difficulty he'll have is we just went through a census, so 2020, which will kick in this next year, and the congressional districts will be redrawn. Well, the Republicans control a huge amount of the state legislatures. So there'll be a huge amount of regerrymandering of districts so Republicans can try to hold on to as many spots as possible. But I think Biden, with this one-person majority in the Senate, even though he acts like he's going to be a good guy, a good player across the party lines, it's his legacy. And he's not only going to do healthcare, but environmental, and the impact of environmental to us will be new construction. They've already been hammered by, all the regulation and the cost of land going up because of all soil runoff and all that stuff. So the cost of new construction is only going to go up, which again will force existing homes to go up at the higher end.
Okay, so that means the prices for new housing will go up.
Well, look at lumber costs. I mean,
yeah, they have to.
So and look at we don't have that much participation in the labor market for construction. We need to add jobs in that area. So Biden is also adding a $15 an hour wage increase for all government employees, and that'll have a ripple impact. Now, Missouri will resist that, but it'll cause inflation to happen. I mean, houses are going up, commodities are going to go up, wages are going to go up. We're going to end up with some pretty big inflation, and the Fed is going to have to get off, easing monetary to change that. And that's not going to happen this year, but there's going to be a price to pay, whether it's 2022 or 23, but it's not looking pretty.
So we're back to the cycle, and it turns slowly. And really, consumer confidence is so important to the real estate field. Vennessa, are you just seeing your home buyer, your prospective home buyers just crazy to get a house? I mean, is it still just a huge sort of wild demand?
Yes, I am. I'm working with quite a few first-time home buyers. They're watching the interest rates. They're thinking originally that they would look to purchase in the spring, but they're watching the interest rates and they're going, oh, should we do it now? So there is some nervousness there. There's a lot of move-up buyers who are looking for larger homes, which is good. But there is this sense of, we have to get in now.
Yeah. And back to the healthcare situation and the healthcare industry. That's one of the things I've always felt was helping sort of moderate unemployment in St. Louis, that we have just a very large healthcare and educational industry or community. And healthcare, if there are changes in the healthcare laws and how we handle it, that could be a dramatic upset for St. Louis in some respects. I think back to my home country of Canada, where the healthcare in the 1970s was basically nationalized through the individual provinces, and it just totally turned upside down. I mean, health insurance is no longer an issue. So long term, there's going to be some issues that St. Louis will have to face in its makeup of its employment. For now, maybe the conclusion is that we're safe on just a residential buying and selling. Probably homeowners will loosen up and feel more comfortable in listing their homes. That could help. They've been really, in our short sale field, they've been very adverse to pulling the trigger, and of course been able to use the forbearance thing to delay any foreclosure. I think the thing to remember about forbearance, and you probably all agree with this, is that with the equity increase in the St. Louis homes in general, which has been substantial, even though it's not as big as, say, other states. So you come out of forbearance and you don't have your job, or you're in a lower paying job and you can't keep your house. That still can be handled by listing agents in the general brokerage community without worrying about a short sale. But there are going to be those who still can't afford the debt, and it's also too high for whatever reason, family illness and so on, that are going to require a short sale. So we're kind of looking, not that we're wanting to have trouble for people, but by towards the second half of this year, I think we're going to see an increase in short sale activity. So we're always coming up to this question: if you were an investor, which I believe you all three probably are, and you have clients that are investors, and so you've got somebody that shows up with a bunch of money to buy what they would call a real estate portfolio in St. Louis. Is this a good time to do that? Vennessa, what do you think?
I'm seeing a lot of California buyers because it's cheaper. They've discovered the St. Louis market because it's so much cheaper than in California. So I'm seeing a lot of investors coming in and a lot of inquiries from California. They're looking, I've had some listings, multifamilies in Soulard. They're very interested in getting into the Soulard area. And I've got local investors who are diverging from their portfolio. They want cash.
Okay, so they're divesting and getting out of real estate.
Yeah.
Barry Upchurch, I know you've got an opinion on this. We've even talked about it.
Mm-hmm. Yeah, Barry, a year ago I said we're selling a lot of our single family home residences, and we are still doubling down on that right now. In fact, I think I've got 20 homes that we've got that we're going to be coming available, and we don't have much resistance from other competitors. So we're seeing, as we know, 6, 7 contracts. The one thing I will say on these contracts is do your due diligence on who's submitting them. The highest price is definitely not the best buyer. And sometimes that might even indicate a weakness in the buyer because they're trying to buy the home and hide their problem. And if there's a downstream deal, especially if it's coming from the East or West Coast, find out who the lender is. Because if it's not a good lender, or they don't care because they're a large volume lender, I just got a deal that got delayed by 2 weeks. Thank God it just closed yesterday. But man, it's it's a nail biter. And most of these deals are taking so much longer, even though everybody wants to buy them. Once you get them, the buyers are like, did I make a good decision? Right. How can I get the money? The roof, the high water heater, everything's up for grabs at that point. So, it's great to get a backup contract, but we know those are hard to get sometimes.
So you really are saying or signaling that this could be the cresting time here, in not this moment exactly, but we're in a phase of the market where we're seeing a cresting of the market.
Yeah, one thing really scares me, and I know there's probably a lot of residential real estate agents and brokers on this call, but you guys need to go talk to your commercial brokers. If the 1031 exchange goes away, the world will freeze up as we know it. And the real estate world will freeze up. And that will be a big problem because that makes the world go around. And people, especially Congress, they have no clue what the 1031 exchange means. I know a lot of people here do, but if you don't know what it is, get educated, because that could have an impact upon, I'd say right now, get out of single family homes as quickly as possible, unless it's your own home. The one thing I will say is housing stock's going to change. We're going to see more 2 master bedrooms on the main level, because guess what? Your mom's going to come live with you, or your elder kid, or your family. I mean, a lot of other cultures share that tradition, and America doesn't, and that's going to change as well. But take a look at the 1031 exchange, and if you can get in the warehouse business in St. Louis, good business to be in.
They need another 16 million square feet of I was reading of industrial space
and get out of office space.
Yeah. Well, we're going kind of month by month on pulling the trigger on the commercial real estate collaborative, because that's a whole interesting story, as you say, Barry, with such a divergent difference between retail and apartments and office and industrial. It's just a whole nother conversation, but it's an important part of the economy in every city. Brian, do you have anything to add about top of market risk? I know that you and your partner, Kyle Fernandez, often will buy houses, refurbish them, and resell. Are you holding on to any at this point? Are you selling more than you're holding? What's your prognostication?
We're always looking for buy and hold, but it's hard. Those are hard to find. And even the rehab properties, of course, are hard to find as well. There's just so much competition. There's so many people out there that are investors and that are doing this. And so to your question, do you make a move, or do you kind of sit and wait? And I think as agents, we're dealing with this question all the time with our buyers. Do they want to sit on the sidelines and see if things are going to change? I can tell you that, this is the 10th year we've been in a seller's market, and the same house that you were looking at last year, this year you're going to pay $10,000 to $15,000 more for. So it's a hard decision. Most of the time people move based on a change in their life, not the market. So people are going to be buying no matter what the market is. So I think it comes down to what's their living situation? Does it make for their life? Do they need to move now? Do they want to own now? Do they want to keep renting? So they just have to make that decision. And for the investment side, I feel like you have to be careful, because if we can, those of you that remember 08 and 09, and not that we're going to get there, it's a shift is not a crash. It's just a correction, which is it's actually a good thing. But if you're an investor, you don't want to be rehabbing 10 properties when that starts to happen, because right now you can spend a little bit more for the front end purchase, because you're getting so much more on the back end because the inventory is so low, and buyers are willing to pay the most for a property that is rehabbed because everything is done. They can move in and not have to do anything. And the same thing with rental. The rental market is so strong right now. I know there's the worry of people not paying their rent and not having to because of the COVID situation. But if you're buying a property, if the short answer is if the numbers work, then we're ready to make a move on a property if the numbers work, because the rent that you're going to get is higher than it's higher than ever. So you're probably going to still do okay. So those numbers still make sense on a lot of the properties. But with that even being said, it's still hard to find properties.
You're right. Well, let's take a break for a minute, and before we start our second panel, have a few questions and answers for say 5 minutes or so. And Dan, you've been following the chat room with people asking questions. Can you give us a question or two here to have the panel answer?
Yes. So one of the questions has to do with interest rates. So local and international, the United States and Janet Yellen and just the whole picture of interest rates. Sounded like the consensus was this year, maybe we might be in a holding pattern-ish. And then next year might be the year where they increase. What do you guys
Any
think
panelists want to take this?
Well, they'll increase. They won't increase dramatically, 50 basis points maybe, and then we'll see another 100 basis points headed into next year is what I'm thinking. The reason why interest rates can't go up is the federal government can't afford to pay their debt. And if those rates go up, they can't afford to pay the cost associated with it. And Biden's talking about another $1.9 trillion to add on top of that tab. And which I don't think that's going to go through exactly the way he thinks it is, unless he strongs arms and basically throws the Republicans off the ship. But we're going to have some pain down the road, and rates are going to have to increase. So
your 50 basis points is 0.5%, and your 100 basis points is a full point.
Right. Yeah. But you got to qualify. You got to qualify. And they're checking everything,
And that's a good thing about this particular trend. Unlike the 2008-9 crisis where anybody that could fog a mirror could get a loan. Mm-hmm. Today, you're really being very much scrutinized by all the mortgage lenders. So, Dan, another question?
Yeah, another question was the rental market. And it sounds like Brian's seeing the same thing I'm seeing is rents have just gone retail prices have gone up a lot, but the rental rates may have gone up more than retail pricing on houses. What do you think, Brian?
Yeah, the rental market is very strong. What we're seeing is you put a property out there for rent, you're getting more than what I would expect even a year ago. I mean, the rental, it's just so strong. And I mean, and these are anywhere between, my experience, anywhere between $900 and $1,700 a month. I had one a few months ago and my phone rang. I'm not kidding. The one that was like 1,700, I was getting 20 calls a day. I mean, the rental market, it's so strong right now.
You agree, Vennessa?
I do. The rentals that I've been marketing, it's exactly like Brian says. You're just inundated, and even though Zillow no longer is syndicating those rental listings, they are still being syndicated. So the emails, your email is full, and even after you make it pending, there are applicants who say, "I'll pay more. Can you just get us in?" So there is kind of there's a desperateness that's coming from potential tenants.
This could mean that we have a greater sort of incursion into the lower third of the properties at the higher end of that lower third where people end up just compromising. Dan, you have time for one more question there?
Yeah, the $15,000, that may be a little bit, well, it is a little bit newer for sure. Some people were asking for more information
on
the
tax credit.
$15,000 tax credit. Yeah.
Anybody want to add to their comments previously? It was you, I think, Barry Upchurch, that talked about the $15,000 tax credit.
Yeah, I'm not as familiar with the mechanics behind all that, but as you know, that'll just stimulate more demand. I will say though that if you bifurcate and look at, I looked at some stats for St. Louis City alone, and if you look at what sold in what MLS calls region Area 3, which is South City, 2,500 homes in the last year, 2,566 sold. If you go to the region 5, which is North St. Louis City, 265 sold in the last year. There's like a tenfold selling of houses in South City versus North. And as we call North, it's kind of north of the divide in the city. There is a difference in the inventory on MLS. South City is basically at 1.4 months of inventory. The North is at 2.4, which is like still very low. But the Realtor organization, which we probably all belong to, and this is a shocking statistic. The 2019 profile was done by NAR. 83% of all realtors are white, non-Hispanic. 60% of the population in the United States is white. We are by and large a white organization, and we're trying to figure out how to be fair housing and equitable. NAR ran into a big buzzsaw when they backed, I think it was Purdue in Georgia for the Senate, and got in a big firestorm. So NAR is going to go through this churning of what is the right thing to do. And Biden has his eye on all that and has opinions about it too.
Okay, helpful. The next panel is something that I've looked forward to for a long time. And I'm going to have our primarily panel with Barry Upchurch and Dan Luig, but I know Brian Preston and Vennessa will have questions they will want to ask as well. So let's launch forth what every responsible agent needs to know about property insurance. Our primary panelist being Dan Luig, an independent insurance agent with the insurance store in Chesterfield. He knows both, he knows the commercial market and he knows the residential market. And I've often thought that realtors and real estate agents need to have some basic things that they advise their clients to do, or pointers they might give. What are those details? Is insurance ever brought up in the conversation with those realtors? So Dan, why don't you give us sort of an introduction to this subject, and then we can have Barry Upchurch be our lead questioner.
Yeah, so thank you, Barry. What I noticed a few years back was when the TRID regulation, everything got into play, real estate agents started really getting more involved on the insurance side, started looking at the 10-day insurability clause and educating their clients about it. And some maybe strong-arm that a little bit and make it like a requirement that they've got to have their insurance locked up. And even though your purchase is 90 days away from now, and you got to have your policy signed and bound and issued, and they're still 2-3 months away from buying. But it's good. Those purchasers are way ahead of the game to get their insurance ready to go. But that insurability clause, that one can be a pretty important one. We had a client the other day, she had a fire, a liability claim, and a hail claim. They had no lender, so they had nobody safeguarding them. And she says, "Hey, I need insurance tomorrow. I'm buying a house tomorrow." It's like, oh my goodness, like you're not going to have house insurance because nobody wants you with 3 disastrous claims on your record. But just talking about the insurability in that 10-day period to check things and make for sure that things are okay and that they're insurable for one is a primary.
So I didn't realize that was a problem, the insurability thing.
Yeah, very big. Most of the time it flies right through, no big deal. Brian Preston, I know he's involved with the rehabs and things. So the knob and tube wiring, the age of the roof, again, the client, they might have a bunch of baggage with them that you wouldn't know about as a real estate agent. So
okay.
Those are kind of some overall.
Are there any issues that come up with regards to how much insurance you take out and what kind of deductibles?
Yes. So those would be kind of the next level things. So replacement cost is the term. So people that follow Dave Ramsey hear him talk about that in regards to insurance all the time is replacement cost, replacement cost, replacement cost. What that means is if there's a fire, tornado, we can tear the structure down and rebuild it again.
Okay. Barry Upchurch, what point should a realtor be communicating as to the importance and timing of insurance and all the things we talked about so far.
Yeah, in my family, next to religion, insurance is probably the most discussed or non-discussed topic. My wife grew up in an insurance agency, and my dad's philosophy was, I don't carry collision on our car, so if you wreck it, I'm coming after you. So that's kind of that's where the divide went. But insurance companies, a lot of they accumulate a huge amount of cash and assets, and they invest those for when the rainy day comes. Obviously, they've had problems with investing in bonds in the fixed income market where they put money. So insurance has to increase dramatically, and it will continue to increase because they can't invest on the equity side as much as they really would like to. Now, in Missouri, the biggest issue is water, right? When we're inspecting homes, it's the roof, it's the basement. In the old days, it used to be, hey, don't worry about the roof because we just need a good hailstorm to happen in the next 3 years or 5 years and you'll get a new roof. Don't worry about it. Those days are over. Now we're fighting with claims adjusters and they're bringing in PEs, structural engineers, to look at the roof to document that what my roofer said isn't true. And so, I don't know, Dan, what you think about that. The other problem is whatever insurance you can get as far as having a flooded basement, special coverage, look into it because a lot of times your insurance coverages don't cover when, your sump pump fails or maybe water gets in your basement. So those are the discussions I have with my clients.
Yes, very good points there.
What about a deductible? How big should the deductible be?
It depends on the property. The other day I was working with a guy who's buying a property that used to be owned by one of the former St. Louis Blues players. He's also a Hall of Famer. And so it's a pretty nice property. We were talking about $10,000 deductibles and he was super comfortable with that number. For the average person buying a normal house, deductibles should be $1,000 or $1,500, maybe $2,500, but it depends on what the client's comfortable with, savings and, because you got to cover the deductible if something happens for sure.
On lower price properties where the borrower might be borrowing up, on an FHA or a VA loan, it signals in some cases that there's not a lot of cash around. And so would you, in that instance, recommend a lower deductible to give them that reassurance that they're getting any repairs done that have to be done?
Yes. Yeah. Most of the time, the lower deductible makes sense. The financial savings you get to take a higher deductible. Isn't that great? The insurance companies don't do a good math equation there, in my opinion. When you have an average claim every 7 years and they're giving you a savings every 10 years where you make your money back, the math doesn't work for the average homeowner. And then with that, if a claim does happen and you've got a higher deductible and you don't have $2,500 laying around, that's a big problem too. So almost always it makes sense to have the lower deductible based on the math. And clients most of the time want to even pay up for the lower deductible. Where the insurance companies get you is a percentage deductible where it looks low, but it's not. For example, I had somebody yesterday that was talking to her and she was buying a house that was a $200,000, $206,000 rebuild. And she goes, oh, this 1% deductible looks okay. I said, great. What do you think that means? She's like, 1%. I said, let's do the math. It's $2,000 deductible. She goes, oh, that's terrible. I couldn't afford that. So what was comfortable 1% turned into very uncomfortable when the math was done. And she did not want a 2% deductible. It was by another agency, not mine. I said, here's how we can make this work for you. And so she was pleased to find there were other options.
Two quick questions. How early should you be brought into let's say the contract's been signed, party knows they're going to buy it. How early should you get involved? Should realtors get you involved?
I think, right away. So, you go to schedule the inspection right away. And so right in that same time frame, I think it makes a lot of sense to have a checklist. It's something I put together years ago for realtors and clients. Here's a timeline checklist. So I saw a whole lot of checklists out there, but I didn't see one that organized things to make it simple and easy for the buyer so that they could be a little bit more stress-free about the process other than being thrown everything at them. So kind of right at the beginning, and lenders are really wanting that these days too. Let's get everything finished in the first couple of weeks, and then we can work out other details as they come up, compared to the old days where we used to do things maybe a couple of weeks before closing and just wrapping up little details. Now it takes longer to get through the process with the regulations and then also COVID and everything else that's happened. So kind of right up front.
Okay. Brian, Preston, you look like you had a question.
And
I was
Vennessa's
just
got
going to
something
say
too.
that our contract state, you have 10 days. There's a contingency built into there. So you won't, when I'm explaining a contract to a buyer, I explain to them, look, you have 10 days to make sure that the property, number one, is it insurable? And Dan, correct me if I'm wrong, that property could cost more to insure if there was a certain situation or a claim that happened. Like, let's say there was a water claim. Now there's a possibility of mold. So that property could cost more than the exact same floor plan next door because of there being that situation. Is that true?
Yes, it's definitely true. Some companies do rate that in their ratings, and you could see a double the price with some companies.
So Vennessa, you have a question too.
Yeah, one thing I was going to state is the reason that 10 days, that contingency is really important, is if there's an open claim on the property, it's no longer insurable. So, and it means it's not saleable. So you want to know whether or not you can get insurance on the property within that contingency, because once it's passed, by the time you get to closing and you find that you can't get insurance on it, then you're in a world of hurt.
Yes, that's exactly why you should look into this stuff early. That fire claim I mentioned, well, she had all kinds of claims out there because her house burned the neighbors' houses, and those claims weren't closed yet.
Oh.
So the insurance companies didn't want to step into a problem until those claims were closed, and so it took some hurdles to get through it. We got it done, but yeah, the open claims really causes an issue.
Barry Upchurch, any comments you want to bring up at this point?
A couple of things for landlords and property owners. If you're putting your properties in LLCs to protect yourself, you need to get with your insurance agent or an attorney and also have you individually listed as an additional insured. And obviously you have to have that done with the bank that you use. The one thing that I do think, and Dan mentioned this, is replacement value. I mean, we've got a bunch of properties that I'm always fighting with my insurance agent about. Gosh, we just had this appraised for $200,000. You're saying it's going to cost $400,000 to rebuild it? I mean, come on, give me a break. But if you negotiate that too fine and you have a big loss, then there's other clauses that kick in that they won't pay you full replacement costs, which is what we're always looking for. So there's a double-edged sword to that end. I will say with both insurance, and this kind of gets back to everybody who's delaying their payment of their mortgages, you still have escrow payments to make for your taxes and your insurance. And so if you're like, hey, let's not pay our mortgage for a while, that's great. Hopefully you're sucking that money aside and hopefully not putting in GameStop or whatever, but you need to pay attention to what your mortgage statements are saying, because there could be a very hefty bill come to pay, and that might come due a lot sooner than you think, not just with the escrows, not just with the P&I. And then all of a sudden you're like out on the street because they're coming after you. And I don't think anybody knows how that's going to play out. So, Dan, I don't know what you think about that, but it's a little concerning.
What I've found is when certain people are given the ability to spend their money however they want and don't have an obligation that's coming due every month, they spend that money. So yeah, they won't have savings for taxes or insurance for sure. So that's an interesting point I hadn't even considered.
One thing I want to bring up is particularly for people that are investors, and maybe everybody knows this, but I just thought I'd mention that if you have actually could apply to just someone who moves out of their house. If you have a house that goes vacant on you, you better be sure that the insurance carrier that you're using, that they don't have a clause in that policy that says once the house has been vacant for more than, is it typical 60 days, Dan?
60 would be the norm, but yeah,
that
45 or 60 days.
That the policy doesn't blow up on you and you don't have coverage, or you think you have coverage and then you have a problem down the road and you're not covered. And I know that in many different insurance carriers, some of them are the ones with captive agents. They do not provide coverage. They may have another company within their family that's a little more expensive that will provide you with the vacancy coverage, including vandalism. Any advice in that respect, Dan?
That one's a super key one. So yes, don't leave your regular home policy alone or landlord policy alone if you got a vacant property. And then secondly, on vacants, you got to add vandalism and miscellaneous mischief.
How about liability coverage? What is
as much as you can? It's super cheap.
Okay. What's your typical average, say $250,000 house? How much liability insurance are they buying?
Almost always it's 300,000 or 500,000. I'll see agents around town doing 100,000. I'm like, what are you doing? Your house catches the neighbor's house on fire. 100,000 might not cover that one, and you might have $100,000 or $200,000 hidden deductible that you're not aware of.
How high can you go on a liability?
Most policies will go up to 500,000, and it's
they don't go beyond that.
$10-20 a year, and then after that you could buy an umbrella policy, and then you can get another $1 million or $2 million or $5 million. So
Barry Upchurch, what have you done with the portfolio of houses to give yourself liability coverage?
Yeah, I'm glad Dan just mentioned that. It's umbrella policies are really a super way to go, and but make sure that for all the entities that you have, that you're being very conscious about making sure that those are all listed as additional insured. And it gets very complicated in estate matters as well. But the vandalism thing that Dan mentioned, we just had somebody take out of another home a washer and dryer and do some damage. They came through the dog door, and there were no security cameras because they moved the furniture out and everything. Luckily, the cops found the van that was stolen that had the stuff in it, and the guy stole the flyer that the agent had. So the cop called the agent up and said, "Hey, I got this washer and dryer. Before I impound it, and you'll never see it again. Can you come and get it?" So he and his dad went and got the washer and dryer and put it back in the house. So, thank God for the cops. I'm sorry, the police. Strange stories, right? We could write a book on all this stuff.
Is there a policy, Dan, that you can get if you say you have 20 or however many rental properties? Is there a policy that goes beyond just that personal liability policy, which it seems to me that's more homeowner personal? Do they have an umbrella policy that's commercial?
There is. Yeah, there is. But you need to have underlying property coverage, and then you can get that additional umbrella.
All right.
Yeah. I had a client, Barry, talking about vacant. He left the country, and he didn't winterize his house. He thought he did. Anyway, it was cold for 3 days one year. His pipes burst on the second story, flooded the house. And I asked him how high the water was in the basement. And he said, "I'm not really sure. I don't know how high the ceiling is down there." A neighbor saw water pouring out of the basement window, and that claim was not covered because he'd been gone for 3 months.
Any comment from anybody? Any questions or comments by Barry Upchurch or our other two helpful panelists?
Just to second that, we had a long time ago, an agent thought he was saving the guy some money, and he turned off all the utilities in the house and didn't realize that when he did that, it also shut down the sump pump. And so when the water, started raining, the whole basement filled up, and we were going to close like in a couple of days. And believe me, that seller had to pay to get us to continue to close because it was a mess. We basically got a new basement out of the deal. So, don't be very careful if you're an agent or broker acting on behalf of your client, because what you do could come back to, being a good Samaritan could come back to haunt you.
So really, as realtors and agents, you have a responsibility to put your clients with very good insurance agents. And I know that the training is to offer them suggestions for two. realtors and eight, but certainly you need people that really give, you're educating, you're sort of educating your client to make good decisions in regards to who they choose as the agent, and also the kind of to ask all the right questions. You act as an educator and a prompter, I guess is the right word. Is that correct, Vennessa?
Yes, yes, I agree.
All right. Well, we've got 1 minute left. I wish I could go on for another hour or so because I'm enjoying this a lot, and I think our panelists, our attendees, which have been a record number in recent times, have enjoyed it too from the looks of it. I want to just say a couple words about the collaborative. Our next collaborative meeting will be March the 25th. I believe that's a Thursday. That'll be a Zoom meeting. At one point, we thought about having that as an in-person meeting, but the way this COVID thing is settling out, we thought, we might be able to buy us a little more time. And then we have 4 in-person meetings at the lodge scheduled starting in late May, the 3rd week in July, or maybe it's the 4th. Anyways, July, September, and November, so that we're loading our live events in the last half of the year with the assumption that the COVID thing will be under enough control that people will feel comfortable meeting and the government agencies will allow us to meet. If we can't meet, then we revert to a Zoom meeting. So that's kind of our general schedule. I want to thank our many sponsors again for making the Real Estate Collaborative continue and be possible. And I want to really thank our 3 panelists today, Vennessa, Mastroianni, Barry Upchurch, and Brian Preston, for their experienced and expert contribution to the meeting. What a great job you've done. And Dan Luig, both as our operating co-host and our panelists on insurance, great job. I want to thank everybody for joining us today, and I look forward to being in touch, and always happy to get emails and messages from you if there's any suggestions or ideas you have for the Real Estate Collaborative. We do have a website. It's the realestatecollaborative.com. You have the in front of realestatecollaborative.com. All of our recorded events, and this one is one of them, are listed on the website if you want to go back and visit it. I know some realtors say, hey, I have somebody in my office who wants to hear it. So that's where you can find those recordings. They're in the archive on our YouTube channel. So with that, thank you all so much for being with us today and for your participation. And we'll look forward to seeing you in late March. Goodbye, everybody.
Thank you, everybody.
Thanks, Barry.
Thank you.
Bye.
Thank you, Brian. Thanks, Vennessa. Thanks, Barry.
Thanks, Dan.
Thank you, Dan. Good to see you all.